Hello everyone and welcome back. Well, 24 hours later, what have we got? We've got the Fed minutes now showing a taper plan later on this year. The Dow and S&P and Nasdaq all down over 1% into the close. Is Wall Street getting ready for a bit of a crash or just a correction? Or is this just another buy the dip scenario? Find out more in today's video. Stay tuned, guys. All right, well, one of the best places that we can start together when we're trying to assess a market is by having a look at the heat map of the S&P 500 and understanding whether it was a broad-based sell-off or it was just a few stocks. From first glance, you'll notice it's red, very red indeed, and it looks like a pretty broad-based sell-off. There were some stocks that did well, such as Tesla, and there were a couple of others that also had green days. But in general, it was up, down, and then into the close, we saw that big selling event, which did break through some key technical analysis levels that we'll be taking a look at through today's video. But let's move over now to one of the most important things, and that is that the close was the key here. Look at that sell-off into the end of the day. That means Wall Street were getting in on that action. They were dumping positions, and whether this is a sustained kind of couple of day fall or a couple of week fall will be told by the story of the closes. The close is the key. I've said that several times. This is the retail hour over here, and this is the real big players coming into the market. So let's take a look now at the sectors that were really getting dominated. XLY, surprisingly, the consumer discretionary actually holding up 0.36%. Energy, healthcare, they were both down. Utilities, as we expect, becomes semi-defensive here, but nothing really was that safe throughout the trading day except for really Tesla and a few other specific stocks. And when we take a look at these Fed minutes, I guess we start to understand why. If we actually scroll through here, during their policy meeting minutes, they showed a few things, and that was the minutes showed plans to consider reducing the central bank's monthly asset purchases of $120 billion in treasuries and mortgage-backed securities. Liked by the end of the year, but they also suggested interest rates could stay near zero for some time. And really, I don't think this is that surprising. It becomes a question of, is the Fed divided? Some people are saying some things, some people are saying other things within the Fed. I think it's just an excuse. We kind of knew this was going to happen. The most important thing for long-time bulls in the market is this last section. There is an expectation that interest rates could stay near zero for some time. Really, that's all I care about as an investor. If they're not going to hike rates, and they traditionally have not done so very quickly, been very, very slow at doing that, it's still long-term optimism. And when you're talking about corrections or pullbacks due to this Fed, skullduggery or whatever you want to call it, the full-on printing press going out of control, this is not something that I'm concerned about in the economy. I know you could be, but if it keeps coming down, it's something that I see as a long-term opportunity more than anything else. So we've talked plenty of times about how we're in earnings. Obviously, we're now getting close to the larger companies all have had their earnings done. That also takes away a lot of the optimism in the markets. After earnings, everyone's, had their full share. They've all bought their calls, and we do tend to see that sell-off into September. Why does that happen? It's after earnings. Here's the stats on it. September being one of the worst years for, of course, the S&P 500 historically over since 1928. We've seen this. We know August also post-election years tends to be a little bit shaky. However, really September has been the weaker month. We also know that tech over 20 years, which we've been talking about, August and September, it's just lackluster. It's usually neutralized. So if we start to see the price action and the technical analysis coming along with that, it does start to strengthen the case for a further pullback, but we will be looking at that more in just a few minutes. So let's get stuck into the technical analysis. Let's talk right now about the VIX. And the volatility index went above 20. Now, we expected it to have to go above 20 for us to get through the 20 moving average on the daily. Usually they go hand in hand. If you're going to break through the 20 moving average on the daily after a nice run, you need the VIX to stay above 20 level. 20 is kind of where it goes from being a normalized VIX market to a fearful market. It did close at these highs, which is significant. And I think that's a very important factor that it holds above 20 for a few days here. The volatility cannot drop because if it does, the bears have run away. They've taken their quick profits. And remember, markets sharply fall, but at the end of the day, the bears can't control the market for a very long period of time. Usually a bear control may only go from 30 days to 90 days. It's not very extended unless we're in a pandemic or we're in a like global financial crisis itself. Let's take a look here at the dollar index, and we'll notice this big double bottom here that's appearing on the monthly. Imagine if the monthly actually closed above this daily 20, this monthly 20 here. This would be a significant level. We have a rejection candle. There's plenty of stops behind this level with shorts on it for the dollar index. And remember, dollar index strength traditionally means risk off in the markets. So again, it's making sense to the current sell-off that we've got going on in overall the markets around the world. We also have the dollar index breaking through a very significant level. You'll notice long leg doji on the previous daily candle and this candle going bullish. If it does close bullish, you would have to think here that the DXY is through the 93.20 resistance zone and it's moving towards bullish case. So it's going to be a pretty good time to be a trader in the currency markets, in the Forex markets. Certainly some great volatility coming back in there. TLT, 20-year bonds, nothing much to report here. Still looking at it going through this particular trend line. If it is going to, we'll keep watching that on the daily. US 10-year has no idea what it wants to do. Double rejection here. Then we get a rejection from the top down, basically neutralizing itself. Closure above the wick up here, bullish on the US 10-year, closure below the wicks down here, bearish back into the 115 on the US 10-year. You can trade banks accordingly with this. We've talked about it a lot on the channel. We've also got gold starting to struggle. Strong US dollar equals traditionally often weak gold. Now, some people would think, oh, but Tom, in this case, we've got the S&P 500, we've got the stock markets around the world falling. We're going to get into gold. That's the hedge against uncertainty. Unfortunately, gold tends to actually run down. If you actually bring it across with the stock market, you'll find that initially it can add as a bit of a, let's call it hedge to the market. But if the market continues to fall, let's say 3, 4, 5%, and it goes underneath that, gold will usually drop with it. And that's something that you should have a look at and see whether you agree with that. Use comparison tool in something like TradingView. It's very helpful. So here we have resistance. We've got support. We've got support. We've got a key zone here. We're looking for a closure under for gold. And that should trigger selling back into the 1772 for day traders and potentially even much lower. So you can already see here how many times this level's been bought and sold off. It's very key for it to hold for gold traders. We've got a series of lower peaks coming through here as well. So we've got lower peaks everywhere. This is the zone. It has to hold here. If it doesn't, then it suddenly moves to the next area. Something to watch for sure. Speaking of other things to watch, we're bringing black gold back. Take a look at this, guys. A closure underneath this 65 support. It acted as support, bounced, lower peak. We talked about it on the weekend video. We talked about it in our live streams, and all of a sudden it closes underneath. This opens up some pretty serious levels for black gold. I could see this thing down, probably down to at least around here, that 61, 62 level. It's currently trading at 64. This could trigger quite a lot of sell-off here in gold, and I mean in black gold, US oil, and it's a pretty serious level to break through. Generally speaking, some people will scale into these types of positions from a technical perspective. And then also there's always that pullback, wait for, a smaller time frame lightning bolt coming off that previous support into resistance, and then seeing that further sell off into the market's volatility. Let's move over to the actual markets themselves. So we'll start off here with the Russell, the smaller cap companies. They took a dive in the trade. We're back down to the daily 200 here. Still trapped in the overall range. Remember, this Russell 2000, you only really need to be scared of it if it gets underneath this heavier support at around 208. We've seen bounce, bounce, bounce. Several times there's been buyers here. Daily 200 might act as like an initial trigger bounce, but overall, I think the key level's at 208. Closure under 208 really could be starting a stampede of selling to do with the channel range. And remember, the channel range being A here would equal B, and we'd be looking at a significant sell-off across the board. Something to be alerted to on the longer term timeframes. Move over to the Dow story here underneath the daily 20. This is something we have been looking at. We get that rejection candle, and then all of a sudden the next day it comes through and just completely smashes through that. That is certainly a bearish style signal from a price action standpoint. It's been a while since some other ones have been found like this, but the Dow, you notice, it's not a good enough trigger because look, It's done it quite a few times. And you need to look back over at left-hand side. If it hasn't worked well in the past, why would you use that as a signal in the future? So Dow not showing us enough. But where we start to get a much bigger story is the seasonal, is of course the Nasdaq weakness. Now we have traditionally not had this Nasdaq rolling over underneath the 20 for quite some time. In fact, every time it's gotten underneath the 20 recently, it's been a long leg doji, so that's indecision in itself. It's been a gap below, but then a bullish movement. This is the first actual big bearish close we've had in a while. And of course, it signals back into the 50 moving average as a first pullback. And then underneath that, we're talking about that 350, which I know there's quite 353. There's quite a lot of puts around there. And then, of course, the bigger, deeper pullback will be around to that 340 zone. So if we get the big correction, we're expecting around 8 to 10% generally from top to bottom. This would make sense because it's around 8%. That's the biggest style correction that you usually see in markets. Generally, most markets will just look to mean revert, which is go back to the 20 moving average. That is what the Nasdaq has done so many times. 1, 2, 3, 4 times through this rally. Look at it. Very, very good level. And that is the general mean reversion. So if we go top to bottom right now from that, let's say we take the peak here, we go down, that's about a 6%. Pretty normal for a standard style pullback. So certainly this becomes more open now, especially if the weekly closes anywhere underneath these wicks. Remember, we've got wick rejection, wick rejection, wick rejection. We close underneath those. Very significant on that time frame. So go back over to the daily. We're underneath the daily 20. So if we put a line around that daily 20 and we scroll down to something like the 1 hour chart, what you'll notice is that it's kind of not really in the perfect zone of touching or like a roll reversal. But we come back down to where it had some problems. So around that 364 here on the QQQ. I could see that the fake market futures may rally up. They may continue down. This is certainly a trigger for many bears to start scaling into the markets for the short term. And then we might pull back up here during trade. And this will be a good test to see whether the bears can really hold it down. Previous supports acting as resistance. It's certainly one of those day trader style areas that people will be looking at. We've got a 1 hour 200 acting as dynamic resistance now. It was dynamic support. It's a place to watch through the session if the session does start rallying. At the time of this recording, that's not happening. We've basically got a flat neutralized market right now. But it was up before and anything can happen as we know. So currently, certainly has triggered underneath. Next stop, daily 50, you would think is quite open here. Certainly the bears are more in control than usual. Now for the bull case, should you be scared? I don't think you should be scared of this market. Remember, this is created by the Fed talking about something. It is an excuse to create this fear. Everyone was buying the dip. I even saw Wall Street Bets, the general consensus, and they used to be put buyers. You know, anyone that's been an old school Wall Street Bets kind of viewer, it used to be literally bears everywhere on that forum. But recently it's been all about the calls, buy the dip, buy the dip. Everyone's been conditioned into buy the dip. And there's nothing wrong with that. But the problem is people were buying the dip like 0.5% down was a dip. That's not how it works. 0.5% down is not really a dip. A couple of percent down at least is more of a dip. You know, you're talking about needing a 4 or 5%. That's what I call a dip. I don't call a dip 0.5%. But anyway, people have been conditioned into it. We've seen a massive amount of calls opened. And we've now got some markets underneath key zones. Again, S&P 500 underneath the daily 20. Every time it's done this, it's tended to go to the 50 moving average. We can scroll out and have a look here. And you'll notice that bang, 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 bang. It's highly statistical. Again, this is all statistics, but that seems to be the way that it has traded. For day traders, the way you look at it, you scroll in, you obviously look at the support resistance on the main timeframes. You have a look and see whether there's any, you know, if there is a rally here, where should we expect weakness? I guess this would be about the 44.20. We pull back up if we get lightning bolt towards the downside or some other trigger there. Again, that's what day traders do. They look for the swings within the larger time frame. They're basically looking for triggers. They're looking for these levels and then they're targeting those and finding other reasons to be in it. So I guess I'll reiterate this. I'm not scared of a pullback. I think you want to have plans if the pullback happens And 1% down is not a crash in a market, okay? 2% down is not a crash in a market. In fact, even 10% down, while it's a correction, is not technically a full-on dead set crash. Remember, a bear market starts at 20%. So I'm not concerned overall for the long-term health here of the market. However, I can totally understand why some people, potentially could be over-leveraged. And we've seen it quite a lot going on in the community. And it's unfortunate, but this is what Wall Street does. We'll move over here to the crypto markets quickly and we'll talk about those. So we're still seeing weakness here in Bitcoin. Obviously gets back underneath this 44,200 zone. Then we move back to the 20 moving average. I would like it back down personally, about 42.5. Just makes sense to me to get a little wick through there and then to see further buying. But if you're a bull on this, I think there's also some really great patterns that could be occurring here. So if you have a look, you've got support being found, lots of wick purchasing. You've got support being found currently, lots of wick purchasing. And you have, of course, your intervening peak. So this could become a really nice double bottom style trade. If we start to get through this 46,000, all of a sudden we're moving towards that 48,000 again, thanks to this nice double bottom initiating that. Very key level here. It's previous supports becoming resistance. Great double bottom style pattern, certainly something I'm looking at. And it's like anything with the markets, you're playing chess. You're looking for key zones. Once you analyze those key zones, then when it breaks either way, you can say, okay, cool. I know which direction this is going to a statistical likelihood over time. So thanks very much for watching the video, guys. We hope you enjoy the videos. We hope you enjoy the updates. Please remember as well, if you want to join the public Discord community that we have, there's a lot of people that love chatting about the markets in there. So click on the description down below or the comment down below and you'll be able to join that. Come and join us also 1 hour before the New York Open. We'll be doing the market live. This one's going to be a doozy. I'm super excited to do it. And I wish you all the best out there. Hopefully you're all making as much money as possible. Bye for now.